Hey, good afternoon, everyone, and welcome to Getting In, a college coach conversation. We have crossed the threshold from March into April, and that means that in many ways, seniors are now in the spotlight. They have some big decisions to make before May 1st arrives. And one of the biggest aspects of that decision has to do with the cost of college and how to pay for it. So joining me to talk a little bit about borrowing to pay for higher education is one of my colleagues out east from the college finance team, Beth Feinberg Keenan. Hey, Beth.
Hey, Ian, how are you?
I'm doing well. Welcome to the show. There is so much that goes into a college financial aid package. Sometimes there's grant money, which is great. There can be work study, but there is also this fairly large portion that might be connected to loans. And so we wanted to talk a little bit with folks on the show today about how to be informed before it's time to borrow for higher ed. And you're the expert, so I just wanted to start with a very basic question. There are a lot of different types of loans out there. Can you identify those for our listeners just so we know what we're talking about here and what to expect when we might get or try to understand that financial aid offer from a school?
Sure, Ian, I can definitely do that. So for families who have received financial aid packages already, you may have seen federal student loans on your children's financial aid packages. So it could be a subsidized loan, it could be an unsubsidized loan, it could be a combination of the two. And if your student was offered a subsidized student loan, it means that you have eligibility for need-based financial assistance. So when you filed for financial aid, you qualified for need-based financial aid and your student was offered a subsidized student loan, and the maximum that they can borrow under that type of loan is $3,500 their freshman year.
Okay.
If they're receiving that full $3,500, then they're likely receiving an additional $2,000 in an unsubsidized student loan.
Okay.
There's no need-based component to that unsubsidized student loan portion. And I'll talk about that, in a minute. But if they don't qualify at all for any type of need-based financial aid, then the student can still borrow, but it's likely that the entire loan is going to be unsubsidized, which means that interest is going to accumulate while they're in school. So that's important to keep in mind, that it's not an interest-free loan, whereas the subsidized portion, interest doesn't start to accumulate until after graduation, after their grace period.
Can I ask a question there? I just want to, for students who don't complete their 4 years of education, but they do receive a subsidized loan, let's say for year one or year two, and then they leave after that second year, if they take a gap year or if they just don't return to school, at what point does that interest start to accumulate on repayment for that loan?
So that's a great question, Ian. So if for a student who doesn't return or a student who takes a gap year, they have a 6-month grace period on that loan.
Okay.
And interest will start to accrue after that 6-month period of time, and they enter into repayment. But in your scenario where you said if somebody goes on a gap year, so yes, that they've used that 6-month grace period, they could very likely go into repayment for that next 6 months. But let's say they return back to school. If they return back to school, they can place their loan into in-school deferment, and they'll regain the interest subsidy on that subsidized portion. And when they graduate, let's say that they continue, the other 2 or 3 years, and they get their college degree, they no longer have a 6-month grace period on that loan. They've already used it. They have 30 days, and they're going to enter repayment 30 days after they finish their degree.
Okay, gotcha. That's helpful to know. So that 6-month period is a one-time period before the interest starts to accrue. You don't reset that 6 months every time you re-enter school.
Correct. They'll only have a 6-month grace period on new loans that they've taken out. So if that person took that gap year and they took out new loans for their last 2-3 years, they'll have a 6-month grace period on those loans, not on the loans that they took out pre-gap period.
Gotcha. Okay, that's very helpful. Now, you've mentioned, you put some dollar amounts attached to these. Was that sound like $3,500 for freshmen for the subsidized loan, $2,000 in unsubsidized loan? I'm not great at math, but I'm adding those up and I'm thinking about the cost of college these days, and $5,500 seems low. It seems like maybe there's more. Now, am I wrong about that? Is there more that families can potentially borrow? And if they need more money, what sources can they go to?
So you're right, Ian. When you look at the cost of college today, that $5,500 doesn't go very far when you're looking at in-state publics, when you're looking at out-of-state publics and private colleges. It might
Mhm,
cover the cost of, a community college for
mhm,
tuition fees. And some families, when they receive the financial aid packages, they might have seen, or the schools that their students are getting accepted to, they might have been packaged with what's called as a plus loan. And it's
mhm.
another federal loan for parents. And parents might be thinking like, hey, this is great. I don't have to pay anything. My entire cost of attendance is covered. We have student loan, we have maybe some institutional money, and we have this plus loan that covers the balance. But that's a parent loan. So if parents don't want to borrow that loan, then they can opt not to take it out, but then they need to know like, okay, like what am I going to do to cover that shortfall?
Yeah.
And there are also private loans because you ask, hey, what are my other options? Where am I going to find all of this information? So there's also private loans out there. There are many private loan companies that offer loans to students. And one question I often get from parents, and I had this question yesterday, was like, we hear about students taking out all of this, like all of this debt. Like, how can they do that with just this $5,500? And
Yeah.
yes, it goes up slightly each year, but these private loans that students are taking out, that's what can increase the overall debt that students have.
Yeah.
And parents, you need to co-sign on these loans, or somebody has to co-sign because your students haven't established credit. Your students aren't likely to have a strong enough income to say that they can repay that loan. So they're going to need a credit worthy co-signer to take that loan out with them.
Yeah, that's understandable. And I think, that's what raises a lot of the concern. I think one of the things that's interesting is that people look at these financial aid packages and they see a menu of options that have been presented to them. And I think a lot of families think, okay, well, here's the situation. Like, this is it. I got to do these things that have been laid out for me. But don't families have the opportunity to pick and choose the different ways that they want to enter into these loan agreements based on what's going to be best for their family, what their college savings account looks like, et cetera? How do they choose what to do and what not to do? Do they even have a choice?
They do have a choice. So
Okay.
if borrowing is part of the plan and how your family is going to pay for college, I always try to encourage families to at least have the student take out their student loan first,
Okay.
because that's really the only pure student loan in the student's name.
Yeah.
And when you compare it to like other, like the plus loan, and you compare it to other private loans, the student loans are likely going to be the lowest interest rate option available to families. But I always want a family to take a step back. I want them to think about, in what you mentioned, savings. Like, what have you saved? Disposable income. What are you paying for your kids today? Is your child like a ski racer? Are they dancing? Are they, playing travel sports? Yesterday I had a family, they told me they pay $10,000 a year for their child for extracurricular activities.
Yeah.
So multiply that by 4. That's $40,000 of cash flow that they won't necessarily be paying when the student's going to school. Well, they will be paying for it, but they can redirect it because they're
Right.
not paying for ski racing, and they're not paying for competitive dance and other extracurricular activities.
Right.
So if a school is offering a family a parent loan, and you figure out that, hey, like, I can borrow $30,000, or I can borrow whatever that dollar amount is, take a step back. Don't sign on the dotted line. Figure out what those resources are that you have and borrow only what you need. Because these loans can get expensive.
Yeah.
And you're doing this for year one. But if your student's going to school for 2 years or for 4 years, multiply that by the number of years. And if this is your first child going to college, multiply that by how many children you're going to be putting potentially through school.
It's a great point. I think a lot of people will think, okay, here we got to scrape things together and we can make it work. And they look at that calculation for that year one and they say, all right, we can afford this with these loans. But you're pointing out, you got to keep in mind that there's going to be 4 years here. And frankly, paying for just 1 year of college and then leaving is much worse, much worse than going for all 4 years and getting that degree, because the degree ultimately is what's really going to matter for that student as they're heading off into the workforce. I wanted to ask you, I don't know if you have an answer for this question, but there's been so much conversation in the national news around interest rates. The interest rates that are set by the Fed, how those are being raised, their effect on all of these other different aspects of borrowing. And I'm curious whether that has affected the repayment rates for student loans, or has affected the repayment rates for Parent Plus loans as well?
Well, right now, because we're in a very unique situation, because especially specifically with federal loans currently at a 0% interest rate, it hasn't necessarily affected too much, because right now we have the freeze, the pause,
That's right.
that nobody's necessarily making payments. I mean, yes, there are families who are making payments, but it is a question that we often get asked about, like, what are we anticipating rates to be in the future as families are looking to put their plan together? Because right now, I think we're in an interesting situation. Interest rates are going up, and families have also lost money on their investments. So they're trying to figure out what makes the most amount of sense. Do we keep our investments invested maybe a couple more years, a year or two, when we use them in the sophomore, junior, and senior year? But if we're borrowing, what are the rates that we're going to be looking at borrowing?
Right.
So for families who are concerned about rates, number one, for the federal rates, I mean, there's a likely chance that they're likely going to be going up. And we should know in about maybe 6 weeks, 6 to 8 weeks, what those rates are going to be for the federal loans, for the subsidized and unsubsidized loan, and for the plus loan. Private loans are really tied toward, tied to prime. And then based on the credit history, the credit worthiness of the borrower. So families who if you're concerned, pull your credit report, pull your credit score, see, kind of make sure that everything's in checks and balance, to make sure that you know what a lender might be looking at. And you can start applying May and June to see if you get pre-approved, and do shop around. I mean, I always encourage families to shop around for student loans, because you want to make sure that you're getting a good interest rate, what the fees are on those loans, and also a repayment term that's going to work for that family.
Yeah. Shopping
And
around is,
thing,
I wanted to ask about shopping around, because that's such an interesting concept. And I think, when I hear, even thinking about things like, you need a new roof for your house, get multiple bids, or you need a plumber to come, have multiple different organizations come. I think that feels daunting. The idea of shopping around for different loans also feels challenging. And it's a much bigger expense potentially, with some real pitfalls if you make the wrong choice in terms of rate, and how the repayment rules fall in line with particular loans. How should people shop around? What should they be looking for? Are there resources that they can go to that will help them to identify stronger loan options versus weaker ones?
Yeah, so depending on where the student lives, sometimes states have their own state loan option. Like, I live in Massachusetts, so we have a loan in Massachusetts called the MIFA loan. Rhode Island has a loan, Connecticut has a loan. So there are some states that have state loans, and they might offer a lower interest rate than some of these big names like a Sallie Mae, a Discover, a Citizens Bank, that offer education loans. So that's the first place. The second place is if a family has a relationship with a credit union. Check with the credit union, because they might be able to get a lower rate with the loan with their credit union that they already have an established relationship.
That's
And
great.
then colleges typically have tools on their website where families can pull up a list of different lenders that colleges have worked with in the past. So that's another good tool to use. And they will give you like ranges of, like, this is what the range for interest rates are for fixed and variable. Pick a couple. Apply for them and see what you get as a rate. And then if you're doing that within like a 2-week period of time, kind of like, if you're car shopping, going to different dealerships, you're not going to do it like spread out necessarily 6 months, but you're going to do it within a short period of time. It's not going to impact your credit score. You're not going to necessarily it's not going to increase your rate at one lender over another lender, because you're doing this within like a 2 to 3 2 to 3 week period of time. And lenders know that you're shopping around. So I would look at those options, compare what you get for rates, look at what the fees are, and also look at what the repayment terms are, because some of them you could get lower rates if you choose to start paying the loan back immediately versus wait until after the student graduates, or even opting to say, hey, I'm going to pay interest only, at least while the student's in school, and then go into paying for principal and interest after they graduate.
So a lot of potential things to consider there, and weighing those strengths and weaknesses across those loans. We've got just a couple of minutes, and I wanted to just ask you, as a family is thinking about this, especially a parent of a senior, they're heading off for higher ed, let's say for the first time in their family, they're trying to figure this out. Should they be thinking about loans just for this year and renegotiating and finding new loans every single year? Or should they really be thinking about a plan for the entirety of those 4 years? How would you recommend families think about that?
I want them to think about an entirety for the entire 4 years.
Okay.
They're not borrowing what they need for the entire 4 years up front, but they're planning for the entire 4 years. Because if somebody is saying, I'm going to switch around from lender to lender, think about keeping track of that when they go into repayment. I'm not going to be repaying one lender. I'm going to be paying 4 lenders or 3 lenders.
Mm-hmm.
I know I wouldn't necessarily want to be in that situation because it's going to be a lot to keep track of. But typically, if you have a relationship with one, you're looking at the best rate. As long as your credit doesn't change that drastically, you should be looking at similar rates in the future too.
Okay. Great advice. I think it's obviously a very complex, challenge. I think figuring out how these loans all come together. I want to put a plug in for everyone that we are doing listener questions next week. We will be doing them again a few weeks after that. And so if you do have questions around specific loans, please get at us at gettingin.voiceamerica@gmail.com or on any of our social media sites, Facebook, LinkedIn, Twitter. You can send us a question and we will be back in touch with you as quickly as we can, or even potentially answer it here on the air. So Beth, thank you so much for walking us through some of the loan stuff. I think it's a challenge, but it's really important that people have this information. So I appreciate you coming on.
Thanks, Ian, for having me today.
Of course. When we come back, we're going to talk about what we have seen as far as trends in college admission this year through this cycle. So you won't want to miss it. Stick around.